Good afternoon. Welcome to this very special episode of Vantage Point by Digijanus. This episode has been adapted from our first episode, which was a panel discussion. So, this one is completely focused on how Autumn and Mike Kruger are disrupting wealth management. So, welcome to the episode, Mike. And let me get started and ask you, how are you and Autumn disrupting wealth management today?
Sure. Um, okay. So I'd just like to start off by saying I don't think autumn is really disrupting in terms of destroying the business or taking over, eating the business of other companies in the wealth management space. I think what I would rather position autumn as something that is we are doing things differently, complementary, working with others rather than disrupting. So, as the starting point, the kind of things that we're doing differently, there's the kind of three main things we're doing. So, first of all, we're providing financial planning without the sales pitch. Yeah. So, traditional providers of financial planning tend to get their revenue from selling wealth products. However, what we've seen is that this leads to misalignment of financial incentives. And so, no matter how well intentioned our relationship managers are or advisors are, inevitably that there is a tendency, just because of human psychology, for people trying to meet the KPIs to sell products that may not entirely be in the best interest of the customer, or at least that's the perception of the customer. And so customers have a feeling that maybe they're being taken advantage of by the advisors, and that leads to fear and distrust, which means they're less likely to take the advice or the financial planning if they receive it. So first of all, we do financial planning without the sales pitch. Secondly, what we're doing is when it comes to planning, we help people understand the impact that their lifestyle choices have on their future costs of health, their longevity, the quality of life, and the cost of healthcare. Because as you know, your lifestyle choices, particularly around exercise and fitness and nutrition and sleep and stress management and these sorts of things, can have a huge impact on your health and the likelihood of developing chronic disease in future. And unless you take your lifestyle choices and your health into consideration, your health costs could completely blow your retirement plans out of the water. So need to include lifestyle and health considerations into your planning for the future. So we're really doing a holistic planning. The third thing is what we're doing is we're providing recommendations and considerations from an open marketplace. So rather than having an exclusive set of partners providing products and services, which we recommend, we take the entirety of the kind of products and services that are available to our customers and make recommendations on that basis. So our customer has peace of mind that we have considered everything and they don't have to go away and do their own research. So we're saving them time, we're giving them peace of mind, and ultimately really inspiring them to take action on those plans. So those are the three aspects.
Mike, thank you so much for that answer. So, what I get is you are looking to collaborate, not disrupt, and the app not only takes care of your actual financial health, but your actual health too. So it comes and everything that you do comes in a non-salesy and a non-biased way. Thank you so much for that answer. That was very insightful. So, Mike, you are one very interesting guest because Autumn is part of SC Ventures, and So, I want to ask you this question. So, why is our banks not doing what Autumn is doing today? Because we know about Standard Chartered; they have invested in this through SC Ventures. But why do you think banks are not really doing what Autumn is doing today?
Okay. Um, Yeah, so this is kind of related to your question to the others, which is about why aren't banks doing this already? And my answer to that one would be banks want to be doing this. They can see is where the future is going. But similar to what the answers that Sam gave, there's a lot of heritage there. And whether that's about the existing revenue structures of the banking industry, or whether it's having investments in technology or in relationship managers and agents, it's very expensive for them to switch to different models. And culturally, um, obviously, banks are by tendency to be very risk focused, very defensive. They have to report to the regulator, as opposed to a fintechs, which are much more about vision and opportunity. And so culturally, this is a very different mindset and a cadence. But banks are increasingly getting into this space. And SC Ventures is a good example of how Standard Chartered it has set up an entirely new vehicle to create the opportunity, a way to explore different business opportunities. Um, so Autumn, the genesis of Autumn was the bank identified a lot of people fail to plan for retirement. And end up much worse off than otherwise that they have to be. Yeah, a lot of people forego a lot of returns because they just don't invest because of fear and distrust of the financial industry and lack of access to the kind of products that they think give the returns that they need. So that was the genesis. The banks saw something needed to be done. There was an opportunity to serve customers better. They wanted to explore a different way of doing business, but they found it was difficult to do within the bank, within the standard operating structures. So that's why SC Ventures was set up and why Autumn was spun out of SC Ventures, to have this freedom to explore a different way of doing business that wasn't part of normal operations, didn't depend on banking systems, wasn't limited by existing business processes, and had a much wider remit when it came to considering taking on risk. Yeah.
Mike, that is very insightful answer for two reasons. One, it explains that how banks are absolutely moving in this direction. Like you give the answer of SC Ventures and Standard Chartered. That is amazing. And two, what you said is that changing business models, overcoming technology inheritance, and also some thought process, inheritance is not as easy as it appears. So that is why somehow startups or fintechs are much better positioned to take to benefit out of these opportunities that are out there. So that was absolutely amazing. Thank you. Hey, Micah. So this is a very, very interesting question. So we usually hear there's things about talent crunch and how the industry is feel like struggling to hire the right talent. Now, I want to ask you two questions. One, as a part of SC Ventures, how easy or difficult it is to get access to the right talent with Standard Chartered being in the background, and two, what are the downsides of being associated with SC Ventures in general from a wider market perspective?
How is life different in SE Ventures? So, on the topic of talent, first of all, I'd just like to thank a shout out to firms like Endowas because the increasing number of fintechs that are doing great work in Singapore is attracting talent to Singapore. I think making hiring much easier. So that's fantastic. And we have this unusual situation where, as part of SE Ventures, we can lend a bit of the brand from Standard Chartered. So we have the ability to attract very interesting candidates who are kind of wanting the bank focus, but also wanting a little bit of doing their own thing. And they want the freedom to go out and make a difference, make a real difference. And so we have this lovely halfway house. So that's quite exciting. Of course, through the bank, we have access to all of the bank's partners. So it's like best in class partners when it comes to rolling out new propositions. That's relatively easy to do, much faster. We have as a genesis, we have the culture of the bank. So right out the gate, we have bank governance, which is very heavy on one hand, but on the other, it means that we have bank grade data security and privacy controls in place. So for customers, we hold the data for customers just as securely as a bank does. So that's great for customer trust. On the other hand, being part of SC Ventures means we're trying to work with fintechs and other banks in cooperation. Yeah, so companies like Endowas, for example, there's definitely a very strong role that they can play in helping people plan for the future, and we recommend those kinds of products and services where appropriate to our users. But for fintechs from the outside looking at Autumn, and they see, it's come out of SC Ventures, there can be a little bit of hesitance about partnering because there's a fear, this is just another bank as part of the bank. Other banks need a bit of hand-holding to get across that line. But once they understand actually that we're independent and we're agnostic as to banks, that conversation changes direction quite markedly. So it's just that initial perception can be a little bit challenging. Yeah. some of the pros and cons.
Thank you, Mike. That is a very, very insightful answer. While SC provides you the access to the right talent, which is almost ready, and with the right entrepreneurial skills, so you have access to a very large talent pool. But going out there and collaborating with other fintechs and banks become a little bit more challenging than it needs to be. So, thank you for sharing that answer. That was absolutely insightful. Thank you so much. So, Mike, coming to you, and out of curiosity, you mentioned that you are already partnering with banks. So, why would a bank partner with you rather than build this out on their own with their own tech teams?
Well, I think within the next year, all of the main Singaporean banks are going to be releasing their own robos. Oh, they'll be doing POCs. They're all going this direction. So they already are doing this sort of stuff. What we see is increasing digitization of banking services, and particularly in the wealth space, all of the fees and margin are going out of the industry. Yeah. The only way to build a defensible business is to really own the customer. I hate that phrase, but is to be customer centric. Yeah, to really understand what the customer needs and to truly provide service. And this is the bit that banks struggle with because traditionally customers have a fraught relationship with trust with banks. We've discussed it already. Looking at autumn customers, for example, like the average number of bank accounts that Singaporeans have in Singapore ranges between sort of 2 and 3 up to 5, depending on how old they are. So people spread their wealth across multiple institutions. They don't want to hold it all with one. There's lots of reasons for this. So no one bank has a complete view of the customer. No one bank really owns the customer. They think they do, but they just don't. It's only the kind of startups that provide a platform play which stitches together all of the different financial institutions and the services and products the customer uses that has that holistic view, that can provide a comprehensive recommendation or advice or planning. So in that regard, structurally, I think, at least with regards to autumn, banks are always going to struggle to come at this just because they're more of a vertical than a horizontal. Um, but in that vertical in the wealth space, all of the banks are going there. The question is, to what extent can they be customer centric? Can they really provide real value to the customer that stands up in comparison transparently with the fintechs in the industry? Like trust is the new currency. They have to be able to demonstrate this. And for a lot of banks, they have huge investment in legacy systems, agents and advisors. It's just very expensive for them to provide this kind of advice. They're not cloud native, they're not cloud native, they're not digital first. It's very expensive. They're really going to struggle to get down the kind of price point that the fintechs can provide service at. And the customers reaping the benefits of all these fintechs coming in.
Mike, thank you for that answer. And it is very interesting. You raised like a few very, very interesting points. Legacy, tech, and infra and business models is, something we have all heard about. But yeah, one of the really interesting points there was how banks are vertical and fintechs like you can go horizontal. That is absolutely, a very, very good, perspective. And, you could stitch together an entire experience and based on the entire relationships that customers have with 2 3 5 financial institutions out there. And you raise a very, very important point that yeah, doing this at the price point that you're looking to do this without the RMs, and it is a self-serve platform that makes it a pretty unique offering and something that financial institutions will still take some time. I'm sure they will, but they'll get there. But they'll still take some time to get there and offer something as seamless as what Autumn does. Thank you. So, Mike, one of my favorite topics to talk about with any startup is, and especially fintechs, is what do you do when big tech, who has been your enabling ecosystem and enabling infrastructure, comes and starts competing with you? So, big tech is in your case, big tech has always been known for their personalized journey and AI and driven experiences. And so, what happens when a big tech organization comes in and offers holistic wellness, just like you with a great user experience and with all the product universe that you do. How do you compete with that?
Yeah. I think what you're talking about is inevitable. This kind of providing a wellness solution. We've seen it in the physical space and getting increasingly into the mental. But it really does come back to the points that Sam made. It's about trust and it's about being able to comply with the regulations. And what we see big tech companies struggling with, in particular this year, is in those two areas. You look at all of the big tech companies, they're really having difficulties with trust and regulatory compliance. Traditionally, convenience has trumped those. Like if you make it easy for people, they are willing to share any of their data, use whatever platform, so long as it makes their life easier. But over the last year or two, people are shifting. You see a real change in the way people are choosing to interact and engage with platforms. They're being more selective about the tools they use, the media that they consume, the platforms that they share data with, what they're sharing, and when they share it. I think we're seeing seismic changes in the way big tech companies operate. And just assuming that they'll be able to get into wealth management, I think is a big assumption. And I think the data is pointing like there's just too big a trust gap for them to be able to jump that. Certainly, yes, in payments, it's much more about convenience. So sure. Question about buy now, pay later, I think is controversially. I feel like buy now, pay later. The value of that is on the evil side of the equation. I think people get into debt much too quickly. They take on debts faster than they should. I feel this is perfectly aligned for a big tech play. Um, um, maybe I shouldn't be getting cheeky about that, but yeah, it really does depend. It depends on the trust and the ability to operate in a regulated fashion. And big tech companies have shown over and over again they cannot be trusted with that.
So, yeah, Mike, you raised some really, really important points around trust and regulation, and I think you when you say that big tech need to do more to gain trust uh, uh, from uh, from the end customers. I think that is a very, very important message, and I also see that there is general reluctance in getting regulated by big tech. So by offering financial services, they would be marching ahead in that direction. So yeah, really, really good point, right? And we'll err on the side of caution and not talk about BNPL right now. So thank you. So, if I could summarize our discussion up to until now, so we are seeing this very unique trend where legacy financials need to disrupt more, whereas the big techs need to get regulated more. And in the middle, in the sweet spot, we see fintechs just like yours, who are making and disrupting wealth management, or in your case, collaborating, not disrupting for wealth management.
Yeah. Easy capital, investor over exuberance. You see the trajectory of the fintech, and most fintechs haven't been around particularly long. So it's very tempting to chart early progress off into the future, and you get multiples on returns. Whereas banks have been around for, and like Stan chart, hundreds of years, and it's very difficult to have a exponential growth from one year to the next for something that hires almost 100,000 staff. It's very difficult to shift that needle in a very short amount of time. So I think what we are seeing is that banks are increasingly setting up corporate venture capital sidecar funds with venture units as a way to leverage their existing customer base business into fintechs. Um, and I think investors are looking for opportunities to climb into that kind of fintech space in ventures that they know are going to be well regulated and not going to get in trouble with the regulators. They're going to be on the right side of the government, particularly when you've got interesting things like crypto going on. It's quite controversial. So yeah, mixed. Easy capital over exuberance.
So, Mike, this has absolutely been an amazing discussion. And before we let you go, I would love to ask you this question. What is one thing you would love to change about wealth management today?
Uh, I'd really like to shift the power imbalance more towards the customer. I'd like wealth management to be much more customer centric. I'd like the customer to have better financial literacy, to be more empowered to make decisions and to turn their plans into reality. Yeah, put the power back in the customer's court.
Thank you, Mike. Yeah, absolutely a wonderful answer again, where shifting the balance back to the customers. An amazing goal, and I really wish you and Autumn, succeed in this journey of bringing the power back to the end customer. Thank you so much for joining us for today's episode, making time. This was an absolute pleasure hosting you. Thank you so much for joining
Thank
us.
you, Lakshya.